is Deputy FA and CAO, Southern Railways. We welcome you, sir. It's a privilege to have you. I now invite Thirubi Srinivasan to kindly address the gathering.
Good morning to one and all. I thank LIBA for giving me an opportunity to share this session with all your people. At the outset, I would like to start with this thing. I am not an academician. I am in the industry, that too in a government sector. So I am involved in the research activity. I am doing a PhD in finance from Madras University. So I was asked by a professor to share my thoughts on volatility and what is this one. So today's session, I will be talking about volatility, what is its impacts on the economy or the economy for the individuals. Then how do we hedge it? See, everybody says yes, volatility has come to stay because of our this one, various reasons. As previous speaker sir was telling about, yes, we are inescapable, our imports are more than exports, our balance of payments are very effective, that is causing weakness of rupee. So first thing is, what is volatility? Because for the benefit of the student community, so I asked that what is the volatility? Because these are technical terms on this one. So volatility is the amount of uncertainty or risk about the size of changes in the value of currency. Especially when we do in the globalized economy, when we have opened our economy, we need to deal with different people, different set of countries. Especially we have seen in the beginning, yes, most likely dependent country is dollar, because every trade, all other countries, they trade in dollars. In fact, we have been going for financing in railways also through various Asian Development Agency and World Bank funding. So though we have a direct contract with Japan and through other agencies, so they also said instead of trading in Japanese yen or this one, they insist our payment should be in the terms of dollars. So that is again volatility, measures of dispersion of asset pricing. For example, when I borrow a loan, so how much interest I am going to pay for this, for commitment what I have to repay after this one. Then this volatility is also very much interesting to the policy makers, because in asset price volatility, because they need to decide what is the impact of the financing schemes. Especially when we do, for example, now in Indian Railways, we talk of financing dedicated freight corridor through external investments. So when we talk of this investment, yes, how much as a policy maker at the end of the period, when my repayment starts, how much I have to pay, what is going to be my quality of asset, what is the pricing. So that is about then second thing is other policy makers in government, like Central Bank of India or the finance central government or Reserve Bank central controller. So they are interested about the market expectations. Especially now our economy has become open to the market. So a lot of trading activities are taking place. So then market expectations and regulators also need to know about volatility, because they need to introduce a mechanism of regulatory service so that the investors are protected. Investor protection has gained a lot of importance in this current scenario. So again, what is the reasons? Again, other result is the input models. For example, a lot of regulators are trying about with the models, like how to measure volatility or how do we risk when this one. So a lot of other models of risk management techniques are also being introduced. Then volatility in foreign exchange rates has increased due to credit crisis, especially right from 2008, US has seen. Then we have seen European crisis, German and other places. Even China and Japan also had crisis. Somehow they were able to make up and without much crisis. Then exchange rate fluctuations have also increased the times of balance of payment crisis, as we have seen. Then how do we measure volatility? When we talk of this one, volatility is a lot of models are come up. In fact, I will gone through a lot of research paper. I will give you at the end of the paper, what are research papers. Volatility can be measured by using standard deviation or variance between returns of the same currency. Higher volatility, the risk is the currency. Suppose we do to high volatile currency we deal, higher is our risk. Then what are the impacts of this? Because the time is very short, I will just go through then finally. What are the impacts of the currency volatility is magnified by use of leverage in participating traders. So more leverage or more risk is that, again volatility is magnified. When the currency becomes weak or volatile, it impacts in many ways. So what are some of the ways what we have seen is, it impacts leading to higher EMIs. Suppose we have purchased in terms of even repayment capacities, our EMIs are there. Then Indian also, for example, Indian systems also, our economy is suffering because of more of imports and more we have today. Higher interest rates have come. Higher interest interest rates are held for a prolonged period, then volatility generally leads to weak currency. Again, we are not able to predict and other things. Always people try to play safe. So that currency becomes weak. Weak currency has an impact on negative growth. So it again slows down foreign investment. As we have seen in India, foreign investment, we are depending very large extent on foreign investment. So once the investors' confidence is eroded, so naturally foreigners have a risk. So they try to withdraw money from our system. Again, it had our own impact on the systems. So then investment becomes less attractive. Then again think education. Most of our Indian people will go abroad for research and further studies and all. Because of the weakening currency, so again our foreign study and foreign trips also become more. Then what is the way out? How do we protect ourselves? Yes, we have to trade with foreign currencies, no other escape. Then another idea as to hedge against the volatility risk. So that is one of these currency hedging is the last lessons, the losing or risk of money losing and the value of the currency of the assets of a company an individual is holding drops relative to the currency. So that's protection. So hedging again can be defined as a position that is established in an attempt to offset currency exposure in some opposite position in another market. Suppose if we see that the dollar is going to be this one, so we can take a position of how do we hedge it to buy times of this other country's currency. That can be done. Firms and individuals dealing with multiple currencies face risk on account of sudden and unanticipated changes in exchange rates quantified as exposures. The most important risk exposure is forex exposure, as we have seen. Currency volatility may also lead to other risks like commodity risk, interest rate risk, wage inflation. Then unhedged exposures, what happen, adversely affects the bottom line of investors' confidence, as I have seen, and it also affects the corporate's cash flow requirements. When a lot of things are taking, it's like speculation, again hedging. Many people misunderstand hedging and speculation. So here I try to give a lot of some differences. What are the hedgers are risk averse, whereas speculators are risk seekers. So hedging is done to reduce the potential losses to make extraordinary profit, not to make extraordinary profit. That is hedging is insurance, rather insurance. Whereas a trade is a speculative. If it adds to long or short position in a company, is carrying while the same trade is hedged, if not by executing the total or open short positions in the market. So what is happening? Suppose we do a lot of in the market, some people want short-term profit, some people are interested in making long-term. When we corporate investments or like government sector or social sector, when we go for investment, we look for a long-term process. So in these cases, definitely speculating is not advisable, hedging is advisable. Then what are the various myths about hedging is, hedging strategies are speculative. It is not so. Because generally people confuse between hedging and speculation. They are not so. Then second thing is hedging, when we talk about this one, many people think they are very complex and they are beyond reach. Then another importance is all the shareholders also think that their value will not increase by hedging because it's going to feature this one, but naturally not so, because once we hedge and we are able to cover the risk and we are able to keep in the investment market value and profits are in term. So once a profit is there, investors get back their dividend. Then coming to this one, what are the hedging strategies? So some of the hedging strategies what is suggested are purchase of forward contracts. So all of MBA students must be knowing what is the forward contracts. Then foreign currency options also. Suppose in a highly volatile market, we have an option, we can always exercise at a time which is not advantageous to us. When to stop. Then another option is, yes, gold is again standard as an international standard. Government can purchase gold and increase its gold reserve so that sucking from the market it is possible. Then native currency with foreign currency is also possible. For example, when other currencies are there, like we can invest in yen or instead of depending on one currency of dollar, so we can switch for the market in terms of trading in terms of yen or in Singapore or Malaysia and other countries where it is. That is possible. Then buying spot contracts also. That is one of the solutions. When the swings are very wide, trade in smaller positions. This is for the trading community, because when the currency volatility is very high and the swings are not predictable, very high, so it's always going for a trading in a small positions, sizing. And correct use of stops. So we should also I'll show you various studies which have shown various mathematical models by where we can say volatility index can be measured. So once volatility index is measured, when you say there is a break-even point at that point, you can always exercise your stop option so that highly currencies can be positioned. Then another thing is, depending upon your investment size or your investment position, you can always take a position which will be expecting what is the natural native return. That is possible. When you are in a losing stream, suppose for example, you have already invested some venture, you cannot go back. So it's always better to average down the size, the further investment, so that your risks have become less and less. Then follow the trends and apply reasonable stops. So empirically analyze, study, and constantly, that's why the business analyst or nowadays a lot of these analyst firms are taking a lot of interest and they are gaining momentum. See, these analysts also analyze various empirical data available and always say this is going to be my trend position. To that extent, yes, some sort of predictions are available based on the following trends. Reasonably, we will be able to hedge our volatile risk. Then avoiding picking up the tops or very bottoms when the fast market scenario. So you'll always averaging it down or pick up the right value depending upon making appropriate studies. So since the time was there, so I have gone through because various research papers, a lot of research having gone. These are some of the research paper which I could come across. There is another one paper published by